Good evening, ladies and gentlemen. Thank you so much for joining in and karibuni sana to our Payroll Tax Compliance webinar today. My name is Pilin Kasara and I'm excited to be your host for this evening. I'd like to throw out a special mention to the people who are joining us and are part of our HR community. I see you, Lillian, David. Thank you so much for always showing up. Always great to see you around. And if this is your first time interacting with ElevateHR Africa, Karibu Sana, we are thrilled to have you join us. I would like to highlight that this webinar is powered by ElevateHR Africa, and we are a cloud-based African human resource management software that's built by young Africans and is made specifically for the African market. So if you're looking, you're sourcing for payroll management software, well, look no further. We are the #1 payroll providers in Africa. So I'd like to Leona our video to just play a short clip to demonstrate this, and then we'll carry on with the webinar. As you have seen from the video, we also have a vibrant community of HR professionals. So if you're a HR who is here and are looking for a space to network, learn and belong, ElevateHR Innovation Network is the place to be. So you'll see a link to join in the comment section. So onwards. I'd love to get straight into the webinar today, and I'd like to introduce our guests today. But before that, I would like to also give a shout out to our partners for the evening. They certainly need no introduction. If you don't know who KRA is, well, you should. I'm pretty sure everyone here is well acquainted with KRA. Thank you, KRA, for agreeing to be a part of this very important training. So our trainer today is David Busaule. He is a business process management and improvement specialist in charge of compliance management at the Business Transformation Office of Domestic Taxes Department, Kenya Revenue Authority. He is also a member of ICPAC, part-time trainer for both that and KESRA. He has a Master's of Science in Finance from University of Nairobi, Bachelor of Commerce, Finance option from the University of Nairobi as well, and project management skills in Princeton methodology. Thank you so much, David Busaule. How are you doing this evening?
Well, looking forward to the forum with the chat professionals today.
Are you excited? You look excited.
We've never done this for a chat professional, so it's a good. I'm looking forward to a wonderful evening.
Thank you so much for agreeing to join us. So part of our audience includes HRs, accountants, and also payroll professionals across the board. So we're excited to have you on board. I know you'll share a presentation shortly. And then afterwards, we'll also have David Buchungu come on board and chime into the conversation. And then we'll also open it up to Q&A sessions. So as David Busaule conducts the training, if you have any questions, feel free to just drop them at the chat section, and then we will get to them at the tail end of the webinar. So thank you, David Busaule. Take it away.
Thank you, everyone. Good evening once again. My name is David from KRA. I'll be taking you through this presentation, just some basics about payroll tax compliance. It's quite a lengthy one, but we'll try skim through it in a way which will attempt as much as possible to ensure everyone moves with us, whether you are a HR professional, whether you're an accountant, whether you are into payroll, or just probably you do high-level approvals but not necessarily involved in the actual payroll processing. I think we'll try put it break it down to some level of basic understanding. So we just go, because of time, let's go directly to the presentation. Then of course we'll have a Q&A, and also I'm joined by my other namesake called David, so it would be hope to have a wonderful time. So what's the basis for pay as you earn? Of course, PAYE stands for pay as you earn, and for all of us who are employed, then you're aware that if you're earning some good money, and by good money I mean 24,000 and above in a month, you must be paying some pay as you earn. Depending, and of course you have guys who are earning quite a lot of money, to even extent of over 10 million per month. So it all depends who you're working for. So that tax pay as you earn is basically the tax charged on employment income, and it is deducted by the employer, because it is deducted at source by the employer, and of course the employer is the one who calculates the pay as you earn, accounts for it, and of course pays it to carry. So the role of accounting for pay as you earn, the role of deducting, and the role of paying to KRA is all it has all been put under the employer's mandate. And of course, failure to do that, again, the consequences will come in. Of course, the presentation as the flyer which was going around, it had taken into account the different areas we're going to cover. So we're not going to follow it, the areas on the advert which was going around, but we'll still cover everything at the end of the presentation. So yes, so that's just the basics. Now what pay is, of course, as I've said, deducted from employment income at source by employers. And it's of course a simpler way of collecting taxes. You can imagine if KRA will be going through calling each and every employee, you are paid $1 million, then you are telling you, hey, you need to pay us 250,000 by 9th. Of course, knowing our fellow Kenyans, you know what will happen with that pay as you earn. It will we may probably not collect anything, including me. I may put off my phone so that KRA can't call me to collect the pay as you earn. So who is liable to pay as you earn? Payee is liable to both residents and non-residents, because it's income brought to tax as provided by Section 3 of the Income Tax Act. For residents, we tax them on their global income, meaning basically if you're a resident in Kenya, and of course, resident doesn't necessarily mean a citizen of Kenya. Resident is a term in taxation to basically mean that someone is being taxed here, probably in Kenya, for the income they earn, and probably is allowed to work in Kenya for at least a day in a given year of income. So again, it's good to, if you're a citizen and you have a permanent home here in Kenya, of course, and then you've been here for at least one day, then because you become a resident. So most Kenyan citizens, yes, they are residents, but not necessarily that all residents are Kenyan citizens. It all depends. If you're not a Kenyan citizen, it all depends on the number of days you've been in Kenya. And I think we'll come to the definition of resident in a slide to come. So emoluments to a resident person, as I said, is global, and both rendered by for services both rendered by him in Kenya or outside Kenya. So again, if you're employed here in Kenya and also you are receiving some, let's say, some income from let's say you are working, let's say, for a company based in Kenya, but also you're offering services for that company probably in a different country, that can still be deemed to be income derived from Kenya. For non-residents, the employment income becomes taxable in cases where the employment or services are rendered to an employer who is resident in Kenya. So if you're a non-resident, if you're rendering services or employment, you have been employed, or you're rendering services which are liable to which employment or services rendered to an employer who is resident in Kenya or probably has a permanent establishment in Kenya. So again, that's a bit different on so in case a non-resident is rendering services to an employer who is not resident in Kenya or doesn't have a permanent establishment in Kenya, then of course their income again is not liable to tax. It is assessed on an accrual basis, meaning it is taxed in the period which it was earned and became due for payment, and not necessarily when you are paid a salary or a wage. So you might earn a certain income, and probably you are being paid in 2022, let's say something like payment in lieu of leave. It may be relating to a period in 2020. So if you're being paid that, then it should be ideally the rates which should be the income should be taxed as per the prevailing rates in 2020. Even if you're receiving the income, the payment in lieu of leave now, you should be able to the rates to be used for 2020. Basically, that is what we mean by accrual on a very simple definition about it. So again, employment income is not necessarily taxed on receipt, but it's assessable on accrual basis, meaning we refer to the period when it was earned or it became due rather than when you actually received the payment. For the benefit of everyone, some of the factors just to consider again when you are charging or calculating PAYE, and these are the questions every employer probably needs to be asking themselves when you're doing that payroll processing, when you are filing that return in iTax, when you're determining is this benefit taxable or not. These are some of the few questions any employer need to ask themselves. Is it taxable? You need to be sure that you are in this and of course pay is applicable to all the emoluments, the salaries, the wages, the cash benefits, the non-cash benefits to a certain extent. So you need to ask yourself what benefits are taxable and which ones are not taxable. Again, for KRA, we only wish employers to tax payee, or rather to charge payee on benefits which are taxable on the employees. As we go by, you realize some benefits are exempt, are probably up to a certain limit. It is not taxable, and of course, bringing it to tax, if you're within that limit, you might be overcharging your employee. And again, as KRA, we may not wish to collect anything more than what is duly owed to us, duly the amounts which is duly due to us, and not an extra shilling, but of course not an extra less. Yeah, not more, not less. We just need employers to do the right thing, charge payee on the correct benefits which are taxable. The non-taxable ones, do not include them in the computation of pay as you earn. We have certain employees probably who might have a tax exemption certificate. These are the persons with disability. Again, if you have some in your payroll, you need to consider them and of course confirm that they have a valid tax exemption certificate, because again, they'll get some benefits up to a certain limit. Tax reliefs, again, please consider there are some reliefs which are applicable to both residents and non-residents. We have some reliefs which are only applicable to residents only. Again, as employers, don't apply all reliefs or all deductions to both resident and non-resident employees, yet some are only applicable to residents and some are applicable to both. Again, that's something you need to be considering. Again, the commission has allowed employers to deduct what we refer to as allowable deductions against employment income. These are deductions which, if you have it, you as a person, if David has it, then, and probably me, myself and Pili, we earn the same salary, then of course, if I have certain deductions which are allowable deductions to reduce the taxable income, then I might end up paying I might end up with a lower payee than Pili, even if we earn the same salary. So that's what allowable deductions, of course, within their certain prescribed limits, that is what they do. And of course, the issue of primary or secondary employee, and also in my own experience, having rolled out iTax for a few years, having been part of the team which rolled out iTax from around 2014. We've seen also some of my friends who change jobs, they are taxed at the same rates with both employers. Both employers allow them a personal relief of that for that month. Both employers graduate the same salary. Then when they come to file the annual return, then their things start being thick, because you realize that you'll always be in a payable position, especially if you're already on a certain tax bracket. Especially if you're already in the 30% bracket. If you change employers and probably both of them graduate the same year, the same month, they use graduated rates in the same month, and also they allow you relief, then you'll have got a double relief. Yet the commissioner requires that you should only have a relief. You shouldn't receive more than one relief. You shouldn't receive a relief from more than one employer. Again, the issue of primary and secondary is an employee. Do they devote much of their time to a certain employer, or are they part-time? Probably you're a part-time lecturer. Again, different taxation aspects come in. So what are the statutory provisions? And on the bare minimum, I know some of us probably we are not involved probably in the real filing, but just from a high level, it is important that at least on the bare minimum, you acquaint yourself with the following sections of the Income Tax Act. Again, just for PAYE purposes. I may advise you to read the whole act, but of course, probably that is not possible unless you have the passion, or you are part of your job, part of your hustle, part of your responsibilities involve having to know everything relating to taxation as provided the Income Tax Act. But at least Section 2, you need to get some definition of some certain common terms. In my subsequent slides, I've captured some of those terms probably which you may need to be aware of. Of course, Section 3, just what is really taxable, what type of income, and what basically the types of income which are liable to income tax, and of course employment income is one of them. And then the aspect of Section 5 of the Income Tax Act, very critical for any HR professional, any accountant, anyone who is involved in one way or another in filing. At least that one, if you can't read all the other sections, at least read Section 5 of the Income Tax Act, because it basically sets in motion how pay is being administered by KRA, what is taxable, what is not taxable, what limits, what non-cash benefits are taxable. So it's quite an elaborate section, and of course it's good to really read that Section 5. It may be of deductions like 18 might be relevant. Pension deductions are liable for tax. Again, Section 22A and 22B might be relevant for that. We don't bog you down so much on the aspect of the law. We just want to have a candid conversation probably around what you really need to know as we go forward. Section 30, the issue of personal relief. 31, insurance relief. Section 31, again, very critical, because effective 1st January 2022, the NHIF premiums, contributions, which are premiums towards NHIF, which is a medical insurance, they have been added to the list of the insurance policies or premiums which are liable to insurance relief. Again, your employees, rather, commissioner again provides for how the employer should account for it. 39 is also relevant because it provides for set-off of any tax paid in a foreign country, sorry, not county, but country. That's a small spelling mistake on the presentation. Sorry about that. This is an aspect where, let's say, David, let me give an example. Probably David works in Kenya, and let's say work for Kenya, and probably also do some other part-time employment, let's say for an employer in Uganda. So when I offer those services in Uganda, the employer might deduct some taxes. The pay as you earn, the version of what is applicable in Uganda. And of course, now when I come to Kenya and I'm resident, I'll still be required to declare both the Kenyan income and the Uganda employment income. But to avoid aspects of double taxation, I'll be allowed within certain limits, of course, if I'll be allowed the tax credits I paid in Uganda to be set off against the tax credits which are liable in Kenya on that global income. Again, third schedule provides for the rest of taxes. We may also refer to the PAYE rules 2011. There are wonderful rules also just to read. In addition to that, together with the PAYE rules, you can also refer to the PAYE guide. I like for especially those who are not involved in the actual filing and probably just want to understand PAYE in a much simpler way. I might refer actually again everyone here to refer to the PAYE guide because it kind of explains certain provisions relating to pay as you earn in a very simplistic manner, which probably anyone can easily understand rather than just reading the act. And of course, 51. Some aspects about some other Tax Procedures Act, of course, the of interest could be the ones for late payment of interest for those employers who fail to file their pay. They are liable to. We'll cover some of these consequences in a later slide, which have captured the consequences relating to non-compliance. Okay, so I think also because of time, we just keep moving so that probably you can also have a good, wonderful time for Q&A. Now, two critical terms come in when you come to employment income, and we have, I don't know, I believe HR professionals have had this issue of contract of service versus contract for service. Of course, contract of service is more of the employer-employee arrangement, which most of us are aware of. But of course, worthy noting is it may be oral, it may be in writing. So it's not a must that an employment contract must be expressed in writing. It may be oral, even it may be expressed or implied. Meaning I can just start coming to your work. I may be engaged by a certain employer. I start showing up for work. They manage me, they give me work, they pay me at the end of the month, and it can be deemed that there was actually a contract of service, whether there was an actual contract in writing or not. And of course, under contract of service, the employer has much control over the employee. They can dismiss the employee, they pay the wages and salary of the employee, and that is basically what probably my arrangement with KRA has. Is more of I have a contract of service. Then when it comes to the contract for service, this basically is an agreement between a third party, a consultant, organization. And of course, the third party, an independent contractor, cannot be an employee. And our case come out very clearly that you cannot be you can't be both. You can't have a contract of service and a contract for service for the same employer. That is, unless maybe there's a scenario one of the HR guys can give us for us to explore further. But it is very hard for David to be an employee of KRA under contract of service. Then at some point, depending on some certain expertise I have or certain services I offer to KRA again treats me as an independent contractor or consultant. And of course, they don't deduct pay as you earn, and probably they do withholding tax. That is very, it's not possible. But again, if there's a scenario, we'll be glad to know. So high level, the difference between contract of service versus contract for service, because again, we've realized some of the mistakes employers do is they confuse the two. They probably word a certain contract to look like that person is a consultant. But when you look at the substance of the contract, basically that is an employee. And of course, KRA will charge you pay even if you're contracted. On the title you're greeted, this is a contract between this organization and this consultant, so and so. It's not probably how you word the contract, but it's more about the substance of the contract which brings out. And some of the issues which even the courts have relied on issues to do with parties. Party, of course, under contract of service is between an independent contractor. The relationship between most employers and employees can only be close to the relationship between landlords and tenants. So some they don't see eye to eye. Yeah? So and of course for an independent contractor, they offer their services on a consultancy basis or more of an expert. Of course, the employer has much more control over the employee through issues of work instructions, ensuring performance of certain meeting of certain milestones, code of conduct to manage their engagement within the employer. For control on the other side, for contract for service for consultants and independent contractors, there's very little control. We agree on, mostly a consultant will agree with an organization on milestones and deliverables more than probably aspect to do with targets. They might have targets, but they're not the way they've been worded or the way they're implemented in an employer-employee relationship. Ownership, of course, company owns the services being offered by the rather not the taxpayer, but rather the employee. And of course, on the other side, the consultant may actually have legal rights to the service they are offering. And of course, they'll demand payment from the organization probably before they change they change the ownership of probably is it a certain software, is it a certain expertise, is it a certain methodology after a certain payment. On terms of taxation, contract of service mostly it's subjected to pay as you earn, while for the contract for service, it's liable to withholding tax, of course, depending on the service which is being offered. Definition of terms, I'll not go deep into all of them, but it's just good to understand that an employer, maybe the definition of an employer, that one you should go through it and allow me just to read exactly how it is so that we can just bring out. It includes any resident person responsible for the payment of, and I think we underline the word resident person. And of course, the next thing we underline is the payment of or on account of emoluments to an employee and an agent, manager, or other representative so responsible in Kenya on behalf of an unresident employer. So, of course, for a resident person, they become an employer because they account for and they pay certain pay. In case of an unresident, any other person acting on their behalf, they can also be considered as an employer. And the aspect of paid, it's good also to address the issue now that we came through the COVID era. Paid basically includes distributed, credited, dealt with, or deemed to have been paid in the interest or on behalf of a person. About this definition of paid is and even tax in a way, of course, at the aspect of an employee offering their services and basically the payroll, meaning they have already offered the services, then of course they are liable to be paid. Now, if you're having cash flow issues, then that probably becomes another issue. But you realize employment income is chargeable on accrual basis, and it relates to the period which the services were offered or when it was due. So again, when you look at that, then whether you have money or not, then you should actually have known that payee has already accrued and it's payable to the commissioner, even if probably you are not paying the employees, as long as they have offered the service to the organization. So permanent establishment, again, and of course the definition has been expanded in the previous legislative amendments, again just to be able to bring as many people in the tax bracket and also bring clarity on how to deal with certain with the changing times in the global arena relating to tax matters. Resident, of course, resident, as we said, is an individual. It applies to an individual. It means you have a permanent home in Kenya, and of course, permanent home it means you're paying a bill. You have a house where you can rest and other things. And of course, once you have a permanent home in Kenya, then of course you just need to be here in Kenya for at least 1 day for you to qualify for a resident. So meaning even those let's say those Kenyans who are in the US and they have a permanent home in Kenya, if they never came back to Kenya uh, uh, in any period between January and December, then you realize from this definition that they qualify to be non-residents. Of course, an individual again who doesn't have a permanent home in Kenya, if they have stayed for those number of days, on aggregate 183 days or more in a year of income, that's almost 6 months. They qualify to be resident. And again, if he has been coming in and out, probably they have been they've been frequently coming in and out of Kenya probably in the last 3 years, then we use an average of 122 days. So let's assume in the last preceding years of income, the last two preceding years of income, and that same year, so let's assume 2022, someone was in Kenya probably for about 100 days in 2022, then 2021 probably 300 days, and then 2020 probably another 50 days. So you need to be added together, and if the average is 122 days or more, then of course they qualify to be a resident, even if in this current year they might probably have spent less than 183 days in Kenya. Okay, some other fees, some other terms which probably, if you offer this, then probably you might not necessarily be an employee, but we might treat you as a contract for service and not contract of service. And I just brought some of these so that you can be able to resonate with the difference between contract of service and contract for service. Because when you're offering a management or professional fee, consultancy fees, then you are kind of doing it at more of an advisory capacity and not necessarily as an employee. And of course, you are liable to certain remuneration, which may be liable to withholding tax and not necessarily pay as you earn. Now, the main issue with residents is you realize for most of these services which are liable to withholding tax, which may be offered under contract for service, most of the resident rates are either probably 3%, 5%. They're quite low. So you realize compared to and it is 3 or 5% of any amount, and of course it is not final tax. So that's why when the taxman comes, when KRA comes in and realizes you treated someone as a consultant yet they were an employee, there is always a revenue risk, because most of the time the pay as you earn component is higher than the withholding tax you might have deducted from that employee. Of course, I brought some of the definition again from the Industrial Training Act on who an employee is. And the Industrial Training Act means the employee means a person employed for wages or salary, includes an apprentice, an indentured learner, temporary, seasonal, and casual worker. Again, very wide the scope of who an employee is. Basically, employee is someone who is being paid wages or salary by an employer. I think if you can just get the definition for who an employer is, we can derive the one for employee. And of course, an employee, when you derive the one for an employee and someone meets the conditions of being an employee, then of course they qualify for pay as you earn. Now, now we are coming to that point where the employer has already engaged someone. This is an employee who has been engaged by a certain employer. So how do we start the taxation journey? Of course, you might an employer might provide, and of course, we now we come to answer the question: what constitutes gains or profits from employment? Gains from profit from employment, they come in two major forms: cash or cash equivalents, and of course, non-cash benefits. Um, cash and cash equivalents are taxable in full, irrespective of the amount you are providing to the employee. And I think probably that is something we really need to, as a take home today. All cash benefits are taxable in full, because there is no allowable limit on the tax benefits. So whichever way you want to call a cash benefit, if you want to call it airtime allowance but you put it in the pay slip, it is taxable. Whether you whether whether it is 500, it is 1,000, it is 1,000, everyone in this session should actually take advantage of that, because we've seen employers trying to word certain allowances in different ways to make it look like, give it even certain words like, okay, where I come from, we take death very seriously. So when you maybe mention something like funeral allowance or burial allowance, hey, I know a certain payroll accountant from the region where I come from might stop taxing that. It's like, hey, we are going against the ancestors. But of course, for carrier, that's a cash allowance and it should be brought to tax in full. So some of the cash benefits include wages and salary, of course, leave pay, just some of the common ones I think which can resonate with some of us here. Leave pay or payment in lieu of leave, sick pay, of course, directors' fees, bonuses, and other cash allowances. There could be many others depending on the employer. Government, in fact, has, I think, was it the other day SRC was saying government has how many allowances? I think there are more than 100 different types of allowances which government has. So so let's start with the allowances. So let's go deeper into the allowances and just see. Allowances might include house, traveling, medical, leave, mileage, seating. Mileage is very synonymous with the members of parliament. I think in my next life I need to be one. When you look at the mileage allowances, they draw, hey, it's someone's salary already by default. Sitting allowances, yeah, sitting allowance, acting allowance. If you are given more responsibilities but you've not been given the substantive position, we tax it. Entertainment allowance, makeup allowance, voiceover allowance. These are mostly in the entertainment industry. Again, very taxable. Gifts and rewards. and we treat gifts and rewards are looked in that if it's received by virtue of employment or services rendered, then it is regarded as a gain from employment. These could be things like tips to waiters, Christmas gifts to employee, and probably long service awards, and many others, which, again, those ones just they are very taxable in their very nature. We have also some private expenses paid by the employer. Some of us might be using funds, might have been issued with funds, which probably postpaid lines by the nature of our duties with the organization. Those bills are being paid by the employer. Probably your telephone bills for the house, they're also being paid by the employer, both private and both whether you're using for private or personal, we are using it for work related or private use. But of course, we'll also come to know the limits under which some of these non-cash benefits are taxable. Again, in some slides to come. Maybe employer pays for you your grocery bills, your water bills, pays for your insurance premiums. Of course, for us, most of us, we contribute to our own insurance premiums, but we might have some certain employers who have provided certain benefits to the employees where they pay some of the insurance premiums. So you go get a policy and they start paying 10,000 towards that policy, and you are the sole beneficiary of that premium. Of course, again, it's brought to tax, even school fees, mortgage payments. And of course, the underlying factor to consider that is as long as they have not been taxed on the employer, then all these private expenses being paid by the employer are actually taxable on the employee. We have compensation for termination of employment, whether it's gratuity, service pay, or lump sum payment on contracts. Again, very much taxable under different scenarios. We'll also cover it as we go by. Tax-free remuneration. We have some employees who negotiate for a net salary. Now, of course, the tax-free remuneration comes in the sense that if you negotiate for a net salary, that my salary would always be $1,000, or let's say $10,000. Whether pay as you earn moves from 30 to 50 to 100%, you will still be paid those $10,000 because you negotiated for the net pay. And of course, that's the aspect now where the tax-free remuneration comes in. Of course, certain employers have invited the employees to participate in the employee share option plans, ESOPs. And of course, at least the law was amended recently, which made it easier for these employees, because back then it was being taxed at the point when the ESOP, it was vested on the employee. But now at least the law was amended to the point where the employee is actually exercising the option, meaning selling the shares. And of course, it will now be the difference between the market value and the offer price for the ESOPs. Okay, now let's continue again with what's gains or profits from employment. Now we come to the non-cash benefits. And I think this is now where the biggest non-compliance relating to pay as you earn is. Okay, even on cash, and this is my own experience having just interacted with employers over the last probably 10 years. Cash benefits have their own fair share of non-compliance, but I think non-cash leads in the non-compliance by employers. And of course, some is by omission, others is by commission, others may just be different reasons. But at least it's good to understand probably why some certain benefits are still taxable, even if from the point of view of an employer, it probably means that you're just probably helping the employee to be a better person. Of course, you have benefits in kind. These are some of the main types of non-cash benefits. Benefits in kind, as I've talked about, provision of services, the employer paying your water bill, your electricity, your water, providing you the house, providing you with servants, watchmen, domestic managers, house helps, and basically all the workers around that. Motor vehicle, housing benefit, even meal benefits. Again, meal benefit, I know most of the employers here probably will cover it as we go by. Other types of non-cash benefits: passages, medical benefit or cover, again to certain extent. Passages are mostly relating to expatriates and them moving more relocation expenses from where they've been recruited to come back to Kenya, to come all the way to Kenya. Of course, there are certain conditions around that. Contributions by an employer to a retirement benefit scheme. Again, this one is taxable, especially if the employer is an exempt from income tax. Fringe benefits, these are taxable on the employer on the loans which have been provided to employees at lower rates. Again, we'll cover that as we go by. I've mentioned meals, other than cash benefits, which are less than 36,000. Of course, they may not be taxable, but anything above that, of course, is taxable. Also, these other aspect of gratuity paid. We have employers who have engaged employees who are permanent, but they are not pensionable. But at a certain point, those benefits relating to gratuity, which is being accrued by the employer, they might pay that amount to a registered pension scheme. Now, if you pay that gratuity to a registered pension scheme and it is more than 240,000 per employee per annum, then of course it's a benefit. You need to tax the extra amount on the employee in the month, of course, which you've done the payment to the registered pension scheme. Of course, education fees to employees' dependents that have been taxed on the employer. Again, some of them may not be liable for tax. Now, benefits exempt from taxation. Let's start now. Of course, I'd already mentioned about passages, but those are the minimum requirements, and it's more of a reimbursement for an employee's travel expenses. One of the things this employee should be, he must be an employee recruited outside Kenya. So you can't an employee can't benefit, you can't say relocation expenses or reimbursement of travel expenses for an employee who is recruited within Kenya. Of course, that one doesn't qualify for this scenario. So the employee must be recruited outside Kenya. He must be in Kenya solely for the purpose of serving his employer. And of course, he should not be a citizen of Kenya. Again, those conditions must be met in totality, all of them, not one of them, but all of them together, because it is and, not all. So all the three conditions must be met for you to allow certain reimbursements of travel expenses to an expatriate as being benefits exempt from taxation. And of course, when he receives such a benefit in cash, let's say you recruit someone from the US for the sole purpose of coming to Kenya, and instead of you paying for their air ticket and their facilitating them to be here, you send them, let's say, $50,000. Of course, then that's a cash sum and it must be taxed on the employee. Medical benefit, of course, medical benefit are not taxable on employees. But again, the aspect you need to bring is for a whole-time service director. And basically, a whole-time service director is a director who dedicates much of their time, devotes much of their time in a managerial or technical capacity to the employer. So these might be more probably senior managers who have probably, and of course they should be owning less than 5% of the shares of that company. Whole-time service director with all other employees. The medical benefit basically does not have any limit whatsoever. But when it comes to non-whole-time service directors, basically these are directors who own more than 5% of the share capital of the company. Then, of course, the Act starts bringing into issue the issue of limits. And also this applies to sole might be allowed per year compared to all other normal employees like me and you and directors who earn less than 5% of the share capital. And of course, the limit of 1 million per year applies also to sole proprietors, meaning a sole proprietor who is having running their business, and of course, they source a medical insurance from one of the medical insurance companies. Again, their limit is 1 million per year, meaning if they use more than 1 million per year, then of course then the extra amount starts being taxable on the employee. And of course also partners, if on behalf of the partners to and The issue of children is also very critical. Beneficiary means the full-time employee spouse are not more than 4 children whose age shall not exceed 21. Again, if some of your employees have more than 4 children and all of them are on that cover, then again, probably that is something you need to consider, because this is the bit which the limit is up to 4 children and they should not exceed 21 years. Let's come to school fees. So of course, school fees paid by the employer is taxable on the employee if it has not been taxed on the employer. That is the and basically what it means, it has not been taxed on the employer, is either the employer has paid for but has not claimed it as an allowable expense, meaning they are paying a higher tax, or they are paying the school fees out of already taxable income, taxable profits rather, which have already been brought to charge. Meals served to employees, again, very critical. I know this is one of the major areas of non-compliance, again, with so many employers, and most of the employers is probably they just didn't know that it was qualifying for a benefit. And when meals are served to employees, whether in a canteen or a cafeteria, operated or established by the employer or a third party with a registered taxpayer, and of course, the meal does not exceed 4,000 per month per employee. Basically, if the cost of providing the meal per employee per month is 4,000, up to 4,000, then it is not taxable. But the moment it goes beyond 4,000, then that cost of providing those meals are taxable on the employee in full, irrespective of. So if it goes to 4,050, you tax that meal allowance in full. You don't say that you are taxing the 50, you tax the full amount. So as part of the tax planning is probably employers, you may need to, don't say I didn't tell you this, I can also help you self-tax now that employers are always asking us, tell us how we don't, how we, tell us how we can pay less tax. Even my friends always ask me that, and it's like, there are so many things on how you can go about it. So yes, probably then part of the tax planning we may need to do is maintain the 4,000 per month cost per employee for providing meals. Don't make it go beyond 4,000. If you bring it to about 20 working days, then that's probably around 200 shillings per working day. Uh, Contributions to pension fund are again up to the first 20,000. Again, they are exempt from taxation. But the aspect of contributions to a pension fund, it's only if the employer is a taxable employer, or rather is taxable for income tax. For employers who are exempt from income tax, or they are not taxable for income tax purposes, then of course uh, the contribution beyond a certain amount becomes beyond 20,000 becomes taxable on the employee. But again, we'll cover that as we come to the issue of pension. Let's continue. Gratuity paid into a registered pension scheme. Again, as I said, if it's up to 240,000 per employee per annum, then of course it's not taxable. But if it goes above that, then of course it becomes taxable on the employee, not the employer, but on the employee. Reimbursements, of course, are exempt from tax as long as the commissioner is satisfied that they're indeed mere reimbursements. Of course, this aspect of you have to give in receipts, you have to give in supporting evidence of the expenses you've done, might come into, uh, and then allowance for period spent away from the duty station. That one is mostly what other organizations, you may refer to it as per diem, others may refer to it as daily subsistence allowance, out of office allowances. For most employers, the act allows that the first 2,000 per day is not taxable. So probably if you're paying someone, let's say 10,000 per day, and then the first 2,000 is not taxable, and if it's not a reimbursement, meaning they'll not come back and 8,000 per day, then of course the 8,000 per day will be taxable. It will be put together and taxed together with the other employment income for that month. So it's not that they're being taxed separately, it will just form part of the gross employment income for that specific month. Of course, for most of us who work for government, I believe some of us here are working for government. For us, we have different per diem policies, which we are not able to. Just a minute. We have different per diem policies, which it exempts certain amounts, of course, as long as they go through SRC and other issues. So yes, if you're there again, those ones may be applicable. Fringe benefit, of course, taxable by the employer. Fringe benefit is for low interest loans provided by the employer directly or through a third party, and an arrangement with commercial banks or even our directors' debit balances, they might qualify for fringe benefit tax, meaning probably the director has drawn more from the company more than the share capital or the director the money they have pumped in into the business. And of course, for advances, again, very critical for our audience here. When an advance is probably paid beyond 1 month, then you may probably consider treating it as a loan and subject it to fringe benefit tax. Otherwise, you might be in non-compliance. Because of time, again, let me just keep moving a bit. That is for fringe benefit tax. Value of non-cash benefits. Of course, motor vehicle benefit. If you provide a motor vehicle for an employee, whether they're using it for both private or company use, it's 2% per month on the initial cost incurred by the employer, or the prescribed value depending on the CC rating. So again, so you realize it's the high of the two. So it's not the depreciated value, but it's the initial cost, because whether a vehicle was bought in 2010, it still can take you from here to Mombasa and back. It can take you to the Mara and back. Of course, the benefits are still, you can see, of course, the company might incur more repairs and other costs, but for the benefit, the employee is still getting the same benefit. Those are some of the, for services, again, certain services an employer provides are also liable to tax. Uh, those are some of the rates. If an employer is paying for your electricity, communal or from a generator, those are the rates for 1,500 per month. If an employer is paying you for water, communal or borehole, again 500 per month. Of course, the higher of this is the prescribed rate, but we can go with the higher of the two, depending if especially the actual cost is higher than this. Then of course we'll not be guided by the prescribed rate, but we'll go with the actual cost of availing that service. And of course, for telephone, whether landline or mobile, we allow 30. We assume a 70% work-related use of those telephone, and of course now we bring to tax the 30% of the bills. I think that is on the value of housing. Again, housing is there. If an employee is provided with a house, 15% of the total gains. If this person is not a whole-time service director or from employment, the higher of the three, or the market rental value of the house or the actual rent. For a whole-time service direct company, as is 15% of the total gains from employment, or the market rent, we deduct it from that. For agricultural employees, those ones who are staying in entities or farms, it is 10% of the total gains from employment. But of course, a director who owns more than 5% cannot be deemed to be an agricultural employee. I think contributions to registered retirement benefit, as I wind up, yes, it's good also to understand this, because we have the maximum allowable per month, which is 20,000 per month, which is the liable maximum liable limit of course, when it comes to the commissioner giving you an allowable deduction, the commissioner will always use the lower of the options. If it comes to the commissioner charging you some non-cash benefit, of course, the commissioner will use the higher of the options. So that is just how the rules apply. Something to bring to maybe something to note is the aspect of employers contributions by an untaxable employer to a registered pension scheme. Of course, in excess contributions, let's say David contributes pension of, let's say, 15,000, and the total pension is 30,000. But of course, the Act allows a maximum allowed of 20,000. So if this employer of David is not a taxable person, or is exempt from income tax, then the component of the employer's contribution above 20,000, for this case it is 10,000, it will be taxed on David as benefit from employment for that month. Okay. Issues of mortgage, I think just to note is if you've secured a mortgage, if you've gone for a mortgage from a financial institution or whichever other qualifying institution, you qualify for up to 300,000 per year, which is 25,000 per month. And Probably what you need to note about the conditions for mortgage is the house must be the house you are staying in, meaning it's purely for residential purposes. It's not the house you are renting, and of course you're only liable to one residence because the act did not consider polygamy, but it happens. But you will decide which home will qualify for the mortgage for the ones who have more than one spouse. And of course the other thing you need to note about this mortgage relief is it's only applicable to the first five financial institutions in the fourth schedule. A bank or a financial institution under the Banking Act, an insurance company under the Insurance Act, Billing Society under the Billing Societies Act, the National Housing Corporation under the Housing Act, and a cooperative society under the Cooperative Societies Act. If you get any other facility from any of those organizations not mentioned here, then of course it may still be called mortgage, but probably you may not qualify for the liable deduction. Home ownership, this one was done away with. We can skip it. Personal relief is applicable to resident employees. Of course, currently it's at the rate of 2,400 per month. Insurance relief is also a relief applicable to uh, resident employees at the rate of maximum 5,000 per month. And of course, it's applicable to life, education, and health. What you've seen is either persons allowing more than that per month, or people probably employers allowing insurance relief on education policies which have a maturity period of less than 10 years. Those ones they don't qualify for insurance relief. And of course, the NHIF relief is also applicable as part of the other insurance policies, life, education, and health, which are liable to these insurance relief. Affordable housing for those ones who want to take advantage of that. It's available at 15% of the amount contributed, and this is an allowable deduction against your gross income. So you might end up paying less income, but there are conditions to this. Wound up. They have an exemption of 150,000 per month. First 150 is exempt. Of course, you have additional cost of devices and non-reimbursable home care and hospital costs at the rate of 50,000 per month. This second bit is usually lost or probably not utilized by employees who are persons with disability. They should also take advantage of the extra amount of 50,000 per month relating to non-reimbursable home care and hospital costs and cost of devices. Because of time, let me just probably go to we'll share this presentation probably because I can see probably time is not so much on our end, and we may just need to stay within the also have a Q&A session. Just allow me probably, sorry about that, allow me to probably just capture something on the industrial training levy, or the NIT of 50 shillings per employee per month. And of course, it's payable through ITAX. So again, we encourage all employers to ensure their compliance with this is up to date. And of course, you can always liaise with both KRA and NITA on the way forward. But the current ITAX return allows you to declare both pay as you earn under sheet B and C, and of course under sheet M1 you should be able to declare the NITA levy details. That there are quite a number of benefits relating to you complying with NITA, including NITA is able to reimburse training costs equal to 200% of your previous year's contributions against all approved trainings which you might engage the Director General. So again, something just to take home on the. Now let's come to the issue of consequences for non-compliance before I bring Pili back. Sorry, I think I've gone beyond my time. Okay, for those employers who don't want to comply with pay as you earn as it should, penalties are there for late filing, 25% of the tax due, or 10,000, whichever is higher. That is the penalty for late filing of a return, as per Section 83 of the Tax Procedures Act. Again, for pay as you earn, we still have Section 37, again, which provides a penalty of 25% of the tax involved, or 10,000, whichever is higher. If you filed on time, but now probably the payment which is being made beyond 9th of the month, then of course you'll be liable to a late payment penalty of 5% of the tax due, which is again under Section 83A of the Tax Procedures Act. And of course, the interest is 1% per month, which is simple interest. So those basically are the consequences for that. Sorry, I think I've shot beyond my time limit. the content was quite something, and I just really needed to pour it out for most of the guys on this sensitization, so that they can be able to just enhance their compliance towards payroll tax. Anyway, back to you, Pili, and thank you very much. I'll stop sharing and then we'll engage in the Q&A. Okay.
Thank you very much, David. That was a very elaborate presentation. I'm pretty sure everyone in the audience has learned a thing or two. You know, I have to mention, when you, as a foodie, so I am a certified foodie, when you got to that part where you're talking about that meals being exempt, provided they don't exceed 4K, my heart swells with joy. I must say, my heart swells with joy. But at this point, I want to also bring in David Muchungu to chime into the conversation. He is a senior finance and capital management professional, a certified public accountant who works with SMEs on a daily basis. So David Muchungu, are you here? I'd really love to hear your thoughts on this as well, and then we will get to the questions. So I see a couple of questions in the YouTube section. I also see some from the community. So we'll be getting to them shortly, right after we engage David Muchungu briefly. Is David here? And yes, Esther, we will share the notes right after. So watch out for that. We'll share the notes to everyone who signed up for this event. Are we able to get the...
Hello, you can hear me, Pili?
Yes, we can hear you, but we can't see you. But the good thing is that we can hear you. So I'd first of all really like you to respond a bit, to chime in on some of the aspects of the presentation that you heard. So I'm going to give you around 7 minutes here and there to go over that. So please take it away. Yeah.
Thank you very much. Thank you, David, my namesake, for that elaborate presentation around the area of PAYE, around the area of earnings arising out of employment, including cash and non-cash benefits, as well as around the areas of non-compliance that touch around cash and non-cash benefits. David, you were very, very elaborate. Although, again, such kind of sessions will probably need more time so that people can also familiarize themselves on the workings around it. I had some queries that I needed to raise. I have an employee who is a doctor and also a lecturer. And therefore, they earn from two employers, as it were. And obviously, their tax brackets are within the 30% tax bracket, as it were. So, if the tax is assessed separately, obviously, the taxman will get less. How should this then happen for such a person who holds two jobs? They are within the tax bracket of 30%. How should the tax be assessed so that at the end of the year, it doesn't pose a challenge when it comes to filing? The other issue that probably I would want David to address is the area around the school fees. As an employee benefits offered by the employer. I heard you say that if the employer does not account for it as a non-allowable tax benefit, then it should be accounted, or rather it should be lumped together as part of the employee earnings so that it's taxed on the employee. Probably you can elaborate around that as well. The other issue I heard is a case where I have an employer working for a resident company, and this employee is a foreigner, and he's only worked for 90 days in Kenya. So in terms of residency status, how should this be treated? He has worked for 90 days. Should he be subjected to PAYE, the graduating rates of PAYE, or the applicable withholding tax for the different countries? For example, 10% for India, or how should it be done? The other one is around mortgage relief, interest relief on mortgages. SACCOs If I have a loan from a SACCO, am I entitled to a mortgage relief? And of course, the SACCO is registered under the Cooperative Societies Act. Probably you can elaborate around that.
Thank you, David, for those questions. Pili and David, am I audible enough again?
Yes, you are.
Okay, let me start with the last one. The issue of mortgage. A mortgage is it's a unique legal contract where even the property is charged on the land and every other thing. So, because I know many people confuse this issue of mortgage and construction loans, which are liable to the mortgage relief, because they believe when I go to the SACCO and I borrow 5 million and I'm given 5 million in cash, then I go and build a house. You realize that is not a mortgage. That is 5 million used to build a house, but for the sake of tax purposes, it's not a loan applicable to mortgage relief, because mortgage, as much as a SACCO is among the qualifying institutions, it has not met the other conditions of what a mortgage contract is between the company lending and of course the person, which they need to charge the property and have other control over the property. So, but in case they go through a real contract which meets the legal requirements of a mortgage, then of course they qualify for the mortgage relief. So I think we just need to separate the aspect of taking a normal bank loan to buy a plot and build it, and going for the actual mortgage where you go through a whole contract, the property is charged and other things are done on that. On the aspect of an employee is resident, an employee working for a resident company, and he has been in Kenya for 90 days. Of course, when they were coming in Kenya, they were coming in as an employee, and my view on that is that they should be taxed on those 3 months. And of course, there's a very small difference, by the way, between the taxation of a resident and non-resident. The only it's not mostly about the rates, but it's more about the allowable deductions and other reliefs which are only applicable to non-residents. So the only difference is that the to residents, which may not be applicable to non-residents. What I've seen mostly in practice, and if I had to go the withholding way them as a non-resident, if the resident state have met the 183 days, 6 months, and let's say about 5 days, when they have met the 183 days, then we transition them to become a resident person, because even at the end of the year, they will be filing a resident return, because there may be no probably difference between the two. And then we come to the issue of primary and secondary employee. You are a doctor, you're a lecturer. The position of care, and I know you've categorically said both incomes are less than 30%. I noted that that bit. Now, the administrative way of how KRA is dealing with this is where you are a primary employee, and there must be one person, there must be this one employer where you are the primary employee, because KRA is avoiding the aspect of revenue leakage, where both employers, of course, graduate and also they give you both reliefs. Yet, the law only requires an employee to benefit from to benefit from a relief from only one employer. So for us, the employer should determine where he is. We call it a primary employee. That is probably where the rates will be graduated and you are given the personal relief. Then where you are a part-time quote, a secondary employee in quotes, or you're not devoting much of your time, then of course the employers are required to treat you as a secondary employee and charge you at a flat rate of 30%, or the prevailing the highest rate possible. But of course, it brings unfairness on certain persons who earn that less income. But the commissioner again comes in and says, if you believe at the end of the year you've been overtaxed, the commissioner should be able to refund you the overpayment. And of course, again, brings you us to the issue of the motive issue of refunds. But basically, that's where KRA picks it up from the aspect of when you're having two employers. When it comes to, I think that was the lecturer, secondary, or school fees. The aspect of school fees is assuming you're working for East African Breweries, which is a taxable person, and they file their income tax return, they claim their liable expenses. Now, the statement we've always been saying is school fees paid by the employer, it's taxable on the employee if it has not been taxed on the employer. Now, how is it taxed on the employer? If the employer is a taxable person, then it becomes taxed on the employer if the employer fails to claim it as an allowable deduction in their income tax return. So meaning they're paying it out of their profits after tax, then of course that is okay. Whatever you decide to do with your money at the end of the day, that doesn't. So that's the issue. If it's not taxed on the employer, then of course we tax it on the employee. But of course, if it has been taxed on the employer, then it is exempt from tax on the employee, and that applies to so many other benefits which an employer pays on behalf of the employee. The same rule applies. If it has been taxed on the employer, it is not a benefit on the employee. But if it has not been taxed on the employer, then it becomes a benefit of the employee. But of course, if taxed, of course, then that changes the whole, because we can't talk about the issue of being taxed on the employer. An employer who is already exempt from tax, then if they pay their school fees, then if they pay employee school fees, then of course that school fees is now fully taxable on the employee. I hope David have done justice on some of the issues you've raised.
Yes, indeed you have. A final one. Now, for the non-residents who work for resident companies in Kenya, I suppose they need to obtain the KRA PIN for them to be facilitated to be able to pay the pay.
Yes.
Okay.
Yeah, that's true. Actually, KRA issues a PIN to non-residents or anyone who is not a Kenyan citizen using the passport. Because once someone has checked in into Kenya, as long as they have a special pass or a work permit from immigration, KRA is able to issue them with a PIN using their passport. Then probably after 6 months or a year when they get the alien ID, it will be fine, but they will already be having a PIN. So probably they will just be updating their PIN from being linked to a passport to now being linked to the alien ID. But we actually issue PINs to non-residents as long as they have a special pass or a work permit, and of course a letter of introduction from the employer. It's actually one of the easiest PINs KRA approve for non-residents because it has the least requirements amongst the other categories of non-residents.
Thank you very much, David, for your comprehensive answers to my queries and also for your presentation. Pili, back to you.
Thank you. So I want to tackle a couple of.
Okay.
I want us to tackle a couple
Okay,
of
thanks.
questions, both coming in from LinkedIn and YouTube, and also the community as well. So Felix Mavuti asks about how pay is calculated in case of court awarded to employees, and then Faith Kiplagat also asks about does pay gratuity apply to both registered and unregistered schemes? So perhaps you can start with those two questions.
Yeah, when an employer pays gratuity into it only applies to a registered pension scheme. That is when the issue of the 240,000 per year per employee limit applies. So meaning if you are paying to a registered pension scheme and now you are paying it, of course the 60,000 will be taxable on the employee because it's above the 240,000 per annum. So that year when you are making those transfers to the registered pension fund. If you're paying to an unregistered pension fund, there is really no taxable benefit on the employee because the unregistered fund means they pay taxes on their income, including these pension contributions. So when they pay tax on it, when they pay the benefits to the employee, then it is not taxable. The reason why the registered pension fund is taxable is because the first 20,000 to a registered pension fund, when they were contributing the pension. But now when it came to an unregistered fund, the fund itself is not taxable, is not exempt from tax. So it means it pays tax just like any other person, and of course now the benefits being paid there, whether being contributed by the employer or being paid by the employee, it's not a taxable benefit. On the aspect of court, the issue of courts again, we might we might require probably further information because court awards might range from different things. And court awards may be relating to probably a contract. It may be an award probably where you some amounts of money and they took you to court, and of course now the court came in to make it clear that probably the amount you paid was lower, and we've seen cases of executives of big corporates probably taking the employers to court. So the issue of court award, I believe there may not be a clear taxation policy. It may all depend on the award is relating to what. If it's relating to probably something which probably you left an employer, he didn't pay you any gratuity or service pay, then of course the court award may look like that is the payment which the court stepped in to force your employer to pay you the gratuity of the service pay, and of course now you can tax it according to those provisions. So those are my comments on the two.
All right, so the next two questions. Frida asks, if you erroneously pay an employee, do you recover the gross you paid them or the net amount they received? And then Mbuvi also asks for clarification on taxation of telephone benefit from the employer. Cites the 70-30 rule and the limits. If it's postpaid, is it a non-cash benefit?
Okay.
So you can tackle those two as well.
Okay, let me start with the telephone bills, whether it's landline or mobile. As I said, all cash benefits are taxable in full. So if you are paying someone an allowance in their payslip, let me start even from that point. If you're paying someone an allowance from their payslip and you call it airtime allowance, and it's in the payslip, but let's say now we come to the provision where the employer is the one footing the bill for let's say the postpaid line an employee uses. Because we are aware of the fact that the employee might use that line for both business and private use, the commissioners allowed 30% of the bill to be the amount which is now being brought to tax. Meaning, if your bill is let me even use, there is no limit on that, because even if your bill is 100,000 per month, your telephone bill, but of course the commissioner may also come to realize, hey, what are these calls you are making anyway? But let's assume that amount, or let's say 10,000. 10,000 is slightly more. If your bill is 10,000, the commissioner will presume 70% of the 10,000 was used for business purposes. So meaning it was part of your work, calling customers, calling your fellow employees and other official work. So the 30%, which is 3,000, is the one which will be brought to tax. So for that one, it doesn't rely on the other rule that benefits below 3,000 are not taxable. This one is treated separately, meaning the 30% of that benefit is brought to tax irrespective of whether it's above or below 3,000. It should not be confused with the other non-cash benefits, which if they're below 3,000 per month, they are not taxable, and if they're above 3,000, then they are taxed in full. Okay. And then the other aspect of pay, when you pay an employee, I think Kevin, I always pray Karen to do that for me. Pay me probably 2 salaries. Because I don't know, is it because it's more for me, this question is more of an administrative question than a tax issue. But when you look at it, when you are paid, let's say you earn 100,000 and you are paid 200,000, even if the limit goes to 70, you realize KRA paid pay on your behalf also of about 25,000. So the employer might actually be pushed to recover the full amount, because the cost to the employer is actually 100,000. Yeah. Because they pay, you received a net of 70, but 30 went but again, for the employee, if the employer does that, then the employee at the end of the year will be declaring less income but with more pay credit. So the employee will benefit from a refund of equal to the pay which the employer might have recovered in addition to the net pay. So that's kind of how I can answer that.
Awesome. Thank you so much. This one is from Mbuvi Mwema. I'm a Kenyan resident offering consultancy services and registered for VAT. Should I charge VAT on my fee note to services offered to a South African company? And then say, oh yeah, just first of all, tackle that one.
Okay. He's a Kenyan resident. He's registered for VAT. He's offering a service to South Africa. Should he charge VAT? And I know where it's coming from is VAT, I think from 1st July 2021, VAT on exported services, like the ones he's referring to, it actually stopped being zero rated. It became taxable. But now, what the Act has done, it has put an exemption that as long as those services are relating to business process outsourcing, then it may still be treated as zero rated. But now, the main issue even KRA and most taxpayers are grappling now is what is this exact definition of what business process outsourcing is? Because everyone might interpret it to suit them, to make them zero, not charge VAT and zero rate that sale. But yes, for Mwema, is it Mbuvi? Yeah, Mbuvi,
Yes.
all exported services are taxable unless they are relating to business process outsourcing. Yeah. So ye mwenyewe vile ana what services is offering, let him now outsourcing service. Of course, then he charges VAT. Of course, Kenya is among the very few countries which are charging VAT on exported services, and I believe in the next budget cycle, we might probably be seeing some changes around this issue. Okay.
So I have a personal question, and then I'll also
Mm.
I have one personal and one biased. Before
Okay.
vizuri kujisema. So I want to bring out the question of refunds and collections. Now, why
Mhm.
don't refunds happen as fast as collections? First of all,
Ah,
Mayo, yes.
ah, okay. Maybe should not be quoted, but of course, when you when when you owe, when you have a tax, when you have some when you have some taxes to pay and tax is due and payable from you, it is considered the way KRA is currently works is KRA is not allowed to pay refunds out of the collections or out of the money it collects. It actually gets an allocation to pay refunds from Treasury. So, and now we most likely some of the challenges we are getting is could be related to funding issues from Treasury on aspects of just being able to pay as much refunds as we can. But again, just having said that, KRA, we are coming up with a new refunds module which will make it easier for employers to be able to feel less pain relating to refunds. We'll be able to do some automatic refunds, even probably in the next 1 week or two. We'll be able to do some automatic refunds relating to certain tax obligations as we go by, and probably in the early next year, we'll be able to have fully rolled out the new refund module, which allows for offset of overpayments. Some will go through processing, others will give you a voucher immediately for you to utilize it against any tax liability. We believe it will also help in cash flows. But for refunds relating to employees, and Pili, probably yours was relating to that, we advised employers to, for those benefits, allowable deductions which employers pay or deduct from employees' pay slips through the payroll, things like insurance premiums, which makes an employee qualify for insurance relief, things like mortgage repayments to the bank or to the lender, which makes an employee qualify for mortgage relief, things like probably for affordable housing relief. All those, we advise employers, if they can, let them provide the relief in the payroll. It is allowable. So instead of an employer paying you 100,000 and he's also deducting 25,000 as a mortgage repayment, and that mortgage repayment qualifies for mortgage relief, they can just allow the interest up to a maximum of 25,000 per month of interest, and they allow it against your so probably on a mortgage repayment of 25,000, depending on the interest, let's say your interest is 10,000. So the employer should allow you that allowable deduction of 10,000 and charge you pay on the 90,000. In that way, they also help in addressing the refunds at the end of the year, because you allow the relief at the point of payroll processing and not necessarily at the point of employees filing their returns. And people like you can be happy, I believe.
Yes, yes, well said. So I think we're almost coming to the end, just 5 minutes to go. So now the last one, I would want you to comment on the role of technology, like in
Wow.
just minimizing errors. So please.
Okay, technology, of course, KRA, we having an iTax platform, which iTax is our current system where employers come and file pay returns. Of course, our pay return is Excel based, and it is important. It's important actually for those organizations who can afford a payroll solution to go for it, because it helps minimize some of these data entry calculation errors, because not all accountants you hire for the sake of filing pay might understand how to tax gratuity, how to tax lump sum on contracts, how to tax different things, which allowable deductions to allow and to what limits, because we've seen employers even allowing employees allowable deductions relating to pension of more than 20,000 per month, which is at the end of the year, the employee comes into a payable position. But again, if KRA realizes that you did that mistake, again, KRA is allowed to actually come and raise additional assessments if you allowed a higher. So using technology makes payroll processing much better. And of course, we are exploring even we currently having the iTax system, but even allow me to mention that KRA is moving towards a new tax system, a next generation tax platform, which we want to the best of our ability, we want to make the filing process as much as simple as possible, as convenient as possible, and this aspect of integrating it with payroll systems will also be one of the key enablers we are looking out to both employers integrating to them directly with their ERP systems, and also integrating through payroll systems like ElevateHR, and we can also see the new KRA is up with the new system.
Wow. Thank you so much, David Busaule. That was very insightful. At this point, I'd like to invite Kefa. Kefa is our product lead, to just make a comment with regards to ElevateHR. Like I said, we are the #1 payroll providers in Africa. Kefa, come on, karibu sana, as we conclude.
Asante sana Pili. Hello everyone. My name is Kefa Mutuma. I'm the product lead at Elevate. And yeah, enjoying the discussion. First, I'd like to thank David, the first David from KRA. That was very intriguing, and I've also learned a lot. And also for David, the accountant, it's been something he didn't mention. It's been our product advisor in regards to seeing the needs in the market, what small businesses have been facing, so that we can automate those processes. And with that, I'll probably, for the people who are joining us the first time, I'd like to just give you a hint of what we do at Elevate and some of the offerings that we have within our payroll module. I'll share my screen shortly. Pili, please confirm for me that you'll be able to see my screen clearly.
All right. Yes, we can. We can see it now. Go right ahead.
Thank you very much. So yeah, we are ElevateHR with our tagline, the people company. And at an overview, we are a cloud-based HR management platform that enables the seamless working of processes and collaborative approach to HR. And we believe people are an organization's most valuable asset, and our goal is to help organization win through developing innovations that help them unleash the potential of their most valuable people. And yeah, we are people-centered, and that's why we bring these webinars, as most of our community people ask, so that we can continually train and equip them with much better knowledge and technology to go about with. So we have a couple of modules. Some of these modules include the payroll module, the core HR module, the leave, and the self-service module for employees to be able to access some services on their own. And I'll talk more about now some of the modules that relate with payroll. We start with the core HR, whereby you first start by defining your company structure, your different currencies, your job titles, employment status, the skills and the nationalities of the employees, as David from KRA has mentioned. They could be resident or non-resident. Are they a permanent? Are they primary, secondary, consultants? Are they contractual? That's where the core HR module comes in to define and save all the employee records under a centralized database, all the copies of the ID, KRA, number, and so on. So that's the entry point to doing your payroll. The second is now, once you've set up all your employees' records sufficiently, made sure the ID numbers, the KRA numbers, the NHIF and SSF numbers are correct, they're a resident, you've assigned them a salary, and all the benefits and deductions at a go. Now, payroll module is now the advanced module that really calculates and automates with the current deductions that KRA has produced, and we usually follow up with their current updates. Also for NSSF, NHIF, the different reliefs are all inbuilt within the system. And you can continually now, we've given an allowance for now people to usually define the kind of benefits they offer within the organizations, whether it's taxed or not taxed, it's mostly up to you. But as you've heard, if it's cash-based, that's taxed by default. And some that people probably don't think are taxed have been corrected. As long as it's in the payslip, that's taxed. So with that, payroll, you're able to generate even multiple payrolls and segment those payrolls as you would want. We generate PDF, password-protected PDF payslips with all a breakdown of how we arrived at the net pay. And then you can configure, as I mentioned, to deductions and other applicable reliefs quite easily. And also specify we've recently launched something to easily specify your own custom formulas. So and other real-time disbursement to your employees' accounts. So the process really for the payroll module involves first to generate your master roll, whereby you get to prepare your payroll. These different approval levels that are inbuilt within the system, whereby your payroll gets reviewed and approved before it proceeds to the next month. This is really to avoid, it's really to maintain the credibility of your payroll. Having eyes really helps, not just because you don't trust the person who's running a payroll, but really to make sure you don't miss anything, because compliance is becoming such a huge thing. Something you might miss might cost you your business later down the line. So, and then we have two ways of paying employees, whereby you get to print the bank CSV, pay or do the direct payments using our online wallet, and then you generate all the statutory reports from the PAYE, NSSF, NHIF, and file them accordingly. So with that, we usually offer other variety whereby the employee will just get to download their own pay slips and request for other self-service platform. And with that, you'll find a link to a demo. If you're very curious to see a demo of the product, there's a link that will be shared, book a demo. And other modules that are coming up to easily manage this is including the performance module and building on top of that. So it goes as low as 150 per employee just for the leave module. And for most small businesses, this is very affordable for them because of the compliance need that come with it. And with that, I'll close and hand it over to Pili. And in case you have any, you're curious on how the payroll actually works, you can get in touch via this email or directly to a link that will be shared directly on this link. And we'll be happy to take you through and also automate some of your processes. Thank you very much, and over to you, Pili.
Thank you, Kefa, and thank you everyone for tuning in to this session. Again, I'll say if you're a HR professional, you're looking for a community of HRs to network, connect, and belong, look no further. The Elevate HR Innovation Network is the space for you. And if you're sourcing for payroll software or human resource management software, Elevate HR is the place for you. So thank you so much again for tuning in. See you next time. Bye.